All right, let's walk through this case. This is actually the first case I ever designed, and it's a great example of what happens when you stop looking at debt emotionally and start seeing it as an opportunity for money to move strategically. This is Bill and Sarah. Collectively, they had 2 credit cards, 1 car loan, 2 student loans, a HELOC, and 3 mortgages. That included a primary residence and 2 rental properties. When we first reviewed their situation, their total monthly debt payments were just under $3,000. If they continued making minimum payments, even with occasional extra payments, their projected debt-free timeline was 29 years and 10 months. But the real issue wasn't just the number of debt, it was the interest. Their consumer debt alone totaled approximately $64,412 with an average interest rate of 9.56%. Over the life of that debt, they were scheduled to pay more than $6,000 in interest just on those balances. Now let's look at the mortgages. Their mortgage debt was approximately $388,016. Over the life of those loans, the cumulative interest rate averaged just over 6%, resulting in more than $249,000 in interest payments alone. When you combine consumer debt and mortgage debt, Bill and Sarah were facing roughly $445,000 in principal, plus over $255,000 in scheduled interest, for a true debt cost approaching $780,000 over nearly 30 years. That's the part most people never see. Now here's where strategy changes everything. Using the new LLC approach, we didn't ask Bill and Sarah to make extra payments, cut their lifestyle, or tighten their belt. Instead, we focused on redirecting existing cash flow and using it more efficiently. By applying the new LLC strategy without paying any extra toward debt, we were able to restructure how their money moved. The result? All of the following were addressed: credit cards, car loan, student loans, the HELOC, and all 3 mortgages. And instead of 29 years and 10 months, their projected debt-free timeline dropped to 13 years and 3 months. That's more than half the time eliminated. Additionally, they were estimated to have over $500,000 in tax-free death benefit to transition to their children, and over 6 figures in accessible cash accumulation from the plan. Just from interest savings alone, Bill and Sarah are projected to save approximately $127,000. But the strategy doesn't just stop at debt elimination. The good news is by year 20, they're projected to have approximately $387,000 in total assets. By year 30, that number exceeds $1 million in total assets. And that's after becoming debt-free. In addition, once the debt is eliminated in year 13, those freed up cash flows can be redirected toward long-term savings, legacy assets, and financial security for their family, all while maintaining life insurance protection, liquidity, and peace of mind throughout the entire process. A key part of this strategy involves repurposing and redirecting cash flow, not finding new money. That includes redirecting their term life insurance premiums into their new LLC strategy, redirecting the overfunding of their 401k contributions that didn't include their employer matches, and using existing cash flow more efficiently instead of letting interest drain the cash flow. This is why we call it the new LLC. It's the living legacy cash flow strategy. It's not an entity, it's a system. This case study isn't about being perfect with money. It's about understanding how money actually works and then structuring it properly. If Bill and Sarah had continued doing what most people do, they'd still be paying debt well into their 60s. Instead, they created a clear path, and that clear path is to debt freedom, asset accumulation, and long-term legacy. And they did it without spending any additional money. If you want to see exactly how this works and how it can work for you step by step, that's what I break down in the new LLC webinar.